Welcome to the Evergreen third quarter review and outlook and positioning webinar featuring Derek Varner of our very own investment committee. And my name is Andy Harris, CEO of Evergreen Wealth Solutions. We're really glad you're here, and it's a very interesting time to be able to talk through what's happening in the markets. We're in a couple interesting periods of time as we've seen the ramifications of COVID, the ramping up of stimulus and money that has flooded the economy, and now the Fed has been increasing interest rates at a dramatic pace not seen for more than 40 years, to where the price for the average mortgage increased from the low threes to the sevens in the last 12 or so months. That's had a lot of impact in various areas of the market, which Derek is going to lead into. When having reviews with clients, one of the things that I've noticed is that when people look back at what's happened with their portfolios over the last 2 years since the market crested in the fourth quarter of 2021, is it seems a little stagnant and unfulfilling to be an investor right now. Last year, bonds were down about 13% and the S&P 500 was down 18%. So most investors were down double digits. And so far this year, in all but a few concentrated areas of the market, we've not seen much in the way of recovery, with the exception of the Magnificent Seven, which we'll hear a little bit more about, those NASDAQ darling stocks. With that said, there are some really interesting opportunities in the market, and we, as financial advisors and investors on your behalf, are pretty excited about where we are and the opportunities that we're uncovering. And we wanted to just spend some time giving you some insight as to what the investment committee has been working on. With that said, let's turn things over to Derek Varner. There you go.
Thank you, Andy. I'm going to share my screen and walk through some slides that will help illuminate our outlook and positioning for the economy and your portfolio. So as we look at returns for the S&P 500 and U.S. stocks in 2023, as Andy said, we have seen somewhat of a recovery this year. Large technology companies are up about 13% after having declined about 18% in 2022. Other parts of the market it's been a mixed bag. So dividend stocks, for example, this year down about 10% after providing a little bit more stability in 2022, down only 3%. Other parts of the market, like small U.S. companies, foreign companies, emerging market stocks, and bonds, all kind of flat to up slightly. What's driving this has been, as Andy mentioned, the U.S. Federal Reserve, after a period of very robust economic growth following the pandemic in 2020, later 2020, and then 2021, the Federal Reserve began to raise interest rates again in an attempt to cool the economy and moderate economic volatility. So we have seen, when we scale back over the last, call it 3 years, we look, which now still includes that pandemic era period over the last 5 years, we do see robust returns across many stocks and asset types. But over the last year, we've been in a challenging environment, with interest rates moving higher and the impact that has on the economy broadly. So we'll talk about where we've seen that create opportunities and how we're positioning portfolios to take advantage of that. I want to remind anyone who's listening to this webcast that we try to share with you our best thinking on navigating the economic cycle and bring you behind the curtain with respect to what we're doing in portfolios. But at the end of the day, we really also want to encourage you to remain focused on the long run and remain focused on your financial plan. But for those interested in learning what's happening in the market and the economy and portfolios, we're going to get into the weeds here in this call. So far in 2023, we've seen large technology companies, as I said, the Apples, Microsofts, Amazons of the world, lead markets higher. But as interest rates have moved up, interest rate sensitive investments like big dividend paying stocks like Ford, Exxon, Verizon, IBM, as a group are down about 8%, More cyclical companies like smaller U.S. companies, restaurants, auto parts manufacturers are approximately flat. So these are areas where we're seeing increased opportunity, particularly in the dividend names, which are now in many cases yielding 4, 5, 6% and are paying dividends that can grow over time as well as the businesses grow. As Andy mentioned, since 2021, it has been quite a challenging environment across pretty much every asset class out there. We saw a high in a lot of different parts of the market: stocks, bonds, U.S., large, small. Basically most asset classes out there are still off of their all-time highs that we set at the end of 2021. So this environment where we're going through a Federal Reserve interest rate hiking cycle has been a challenging one, and it's been difficult to sort of wait through that. But these things happen; these are normal, and we think it's going to create opportunities on the other side. One of the interesting elements of the market that we've noticed more recently is just the level of concentration in the largest U.S. companies. So when we look at the S&P 500, the 10 largest companies now represent a record almost 1/3 of that index. And you can see some of the names that represent that 1/3. This level of concentration is not normal, and we haven't really seen this level of concentration since back in the late 90s around the tech bubble. So something to be cautious of, and we're increasingly looking at other parts of the market for value. When we look at the economy, market valuations, and then technical forces broadly, we are still constructive on the opportunity set for investing. A little bit more cautious today for a handful of reasons, which I'll talk about. The labor market has been a real source of stability for the economy through this Fed hiking cycle. So the unemployment rate is still near record lows. We're still seeing a record number of employed Americans every month, and net new jobs being added each month. But we are starting to see signs of that trend slowing. So that's one reason for caution. Corporate earnings have been relatively flat year over year. They're hanging in there, not significantly up or down. Household sentiment, so how you and I feel about the future for the economy and the future for our own financial condition, that has been low, and it's been ebbing between moving higher and lower based primarily on inflation, so prices at the gas pump or the cost of buying a home. And we've seen gas prices rise more recently. We've seen home prices rise. We've seen mortgage rates rise. So that's an area where we're starting to see some stress on the average household, which we all probably feel on this call. So that's another area of caution for us. Inflation is starting to come down, which is positive. And we look across a lot of different ways that's measured. Not every measure. So I just mentioned energy a moment ago. Energy prices are still rising. And then financial conditions. The Federal Reserve has been raising interest rates to try to slow the economy. The reason why the Federal Reserve was created was after the Great Depression in the early part of the last century, to really promote economic stability and to help smooth out the boom and bust cycles. So we went through a big boom cycle following the pandemic, and now the Fed is trying to moderate economic volatility and create a smooth landing and get inflation under control. Across valuations, it's an interesting market because at the top level, the large technology companies look fairly priced at best, but there are a lot of other parts of the market that look very, very attractive to us today. And we'll talk about later in this presentation what those are. On the technical side, we're starting to see investor sentiment get a little bit washed out. We like the old Warren Buffett quote, "Be greedy when others are fearful and fearful when others are greedy." We're starting to see more concern in the market again, which I think is healthy and may create a buying opportunity. As I said, the labor market has been in good shape. So we see a record number of employed Americans. We see an elevated number of job openings and still very low unemployment, which are all positive. Household financial conditions, we see relatively low levels of debt service. So how much we're spending to pay our monthly mortgage and our credit card and student loans, et cetera. low delinquencies on mortgages. We are, however, seeing credit card balances tick up. So maybe some consumer and household spending has been financed on credit cards, which is one area for caution. When we look at household sentiment, we see that it's really struggled to recover since the pandemic of 2020. So household sentiment, again, how folks feel about their financial condition and the future of the economy, has been below average and struggling to get back above average. Retail sales are down year over year, are negative year over year. Gas prices are higher, mortgage prices are higher, and the affordability of a home, because of high mortgage rates and high home prices, is creating a very low affordability environment. So all of these things give us pause with respect to the health of the U.S. Consumer and U.S. households on average. Household savings have also been getting depleted in a higher inflationary environment. So if you look at this great chart from Bloomberg, it shows since pre-pandemic, so March of 2020, the basically the bottom 80% of households now have less savings than they did pre-pandemic. So that's just another area of caution, that households have depleted that savings cushion that they had from stimulus checks. Why is this all happening? The U.S. Federal Reserve is raising interest rates at a very aggressive pace to get inflation under control. They're raising interest rates at the fastest pace since over the last 4 decades, essentially. So this has the effect of chilling the economy and slowing down economic growth and slowing down inflation, which is a bad thing for the economy, but it is a good thing for savers. So we're starting to see, I'll come back to, it is a good thing for savers because now we can get 5% plus on our short-term investments, and our bonds and dividend stocks are paying higher interest rates. So we'll talk about in a moment how that influences portfolio positioning and our outlook for returns. Inflation is coming down, so we're starting to see in many areas inflation move lower, and year over year aggregate inflation has been in the kind of low high 3% range, which is positive. So we believe we're closer to the Federal Reserve no longer needing to increase interest rates to slow down economic growth and to slow down inflation. When we look at past interest rate hiking cycles, so we can study these over the last 50 years, we've gone through about 6 Federal Reserve interest rate hiking cycles where the Federal Reserve is raising interest rates in an attempt to slow the economy, or if we go through a period like we did in 2008 or 2020, when the economy needs more TLC, the Fed will lower interest rates. So when we look at the past Fed rate hiking cycles, when the Fed begins to increase interest rates, that tends to be an okay time to invest. But when they stop raising interest rates, which we believe we're close to that point when the Fed stops raising interest rates, the returns over the next 1 and 3 years tend to be very good and above average. The most recent analog to this event was at the end of 2018. The Fed, after holding interest rates near zero for much of the decade that followed the financial crisis of 2008, the Fed began raising interest rates to try to get back toward a more normal level through 2016, 17, 18. And we got to the end of 2018, and the Fed was raising interest rates into an economy that was showing some signs of softening. The stock market picked up on that and sold off about 20% into Christmas Eve of 2018. The Fed began to see signs of the economy softening, communicated that they were no longer going to raise interest rates, and the market began to recover and was up about 23% in the subsequent year. And the Federal Reserve Chair, Jerome Powell, was in the leadership position at that time as well. So a lot of this presentation has focused on near-term economic cycle And we just want to remind investors that, number one, they should focus on their long-term plan. But number two, the stock market and the economy aren't always at the same thing. It may seem counterintuitive that the Fed stops raising interest rates as the economy is slowing and the market rallies higher. But oftentimes the stock market and investors stock prices are made up of anticipation about future cash flows. And so we started to see the market move higher in 2019 and into 2020 as the Fed stopped raising interest rates and actually went on to lower interest rates. We could see that same environment again in the next few quarters. The fourth quarter is also tends to be one of the best for equities. So we see the average return in any given quarter is just a little bit below 3 when we go back to 1988. The fourth quarter tends to be the best one on average, with about a 5% return for stocks. Investors have become more negative again. So we're seeing more negativity in the market, less bullishness. As we said, be greedy when others are fearful and fearful when others are greedy is the great Warren Buffett quote. We're seeing more and more fear in the market, which makes us think that today would be a better time to invest than if the opposite were true. While we wait and while we hold a diversified portfolio, one of the nice things is that the Federal Reserve interest rate hiking environment is that we can now get 5% plus yields on very low risk investments. So money markets yielding about 5%, short-term treasuries, 1-2 year treasuries yielding about 5% to 5.5%. 10-year bonds are still about 4.5%, but I think it's important for folks to think about their long-term horizon and recognize that money market yields can change very, very quickly. So we would encourage folks that have any extra cash on the sidelines to consider trying to lock in some of these longer-term rates now, because they may not last, candidly. When we look at valuations for stocks, the S&P 500 is trading about 20 times next year's expected earnings. When we just equally weight that index, we strip out the effect of those large companies, it's trading about 16 times earnings, which is pretty average. So we think the largest US companies are trading at about an average valuation over the last 10 to 15 years. Parts of the market we're very excited about are areas like small cap, which are trading at about a 50% discount to their large cap counterparts. They typically trade in the 20 to 30% range because of their smaller size and more narrow focus. But the 50% discount we think is a real buying opportunity. Foreign stocks are the same thing, about 46% discount. We think there should be a premium for US securities, but a 50% discount we think is very compelling. Again, taking it back to the longer term and trying to, help reorient our clients who've entrusted us with their wealth toward their long-term plan and the long-term investing. One of the great investing adages is it's time in the market and not timing the market. So we try to navigate the economic cycle for our clients and find great opportunities for them. But at the end of the day, one of the most powerful things you can do is stay invested and stay focused on your long-term plan. So what you see on the screen here is I'm just going to focus on the green here, which is stock returns. In any given 1 year period, stocks over the last since 1950 have been up 50% or down 40%. That's an enormous range of outcomes, and that can be very intimidating. When you just scale back to over a rolling 5 year period, you see that most of the time stocks are positive. When you look at a rolling 10-year period, you see that most of the time almost all of the time stocks are positive. And when you look at a rolling 20-year period, stocks are always positive, and the worst rolling 20-year annualized return was 6%. So I think this makes a good case for staying invested and maintaining your exposure to risk assets in pursuit of your long-term financial goals. In terms of portfolio positioning, we're neutral on risk today. We're starting to skew more toward active stock pickers. We think there's dispersion in the market and there's potentially diamonds in the rough out there. We're neutral weight on large cap companies. We're overweight small and foreign companies. We're starting to add more to fixed income that's paying, as we said earlier, 5-6% interest with fairly low risk, which we couldn't have gotten 3 years ago. So it's a much easier environment to earn a decent return than it was just 3 years ago. The same thing is true for dividend-oriented stocks, which for a taxable investor have more favorable tax treatment. And those are yielding 4-5-6%, plus the potential for those businesses to grow and those dividends to grow over time. If you've seen our communications, you know we're long-term bulls on healthcare, infrastructure, and technology. So to sum up, before I pass it back to Andy, the market has recovered in 2023. We were positioned for that. We did not expect a recession, which was feared by many investors in 2022. In early 2023, we stayed invested and our clients benefited. We do think it's possible that we could go through a mild recession in 2024. So we're positioning portfolios accordingly to be able to take advantage of any dislocations that may occur. While we wait, fixed income, dividend stocks are all paying fairly attractive yields today. So we think we're getting paid to wait and for better opportunities in the future. And we want to remind our investors that have entrusted us with their wealth, stay focused on your long-term plan under uncertain economic conditions, and we will do our best to navigate the cycle on your behalf. Thank you.
Derek, thank you so much. That was a fantastic and very thorough presentation. I'd like to thank all of you for joining us for this insightful market webinar. We hope that you found this information and the strategies shared valuable and actionable. As we conclude, there's a couple highlights I'd just like to pull out just to recap. One, with the increase in interest rates to long-term averages that we've not seen for many years, it's now easier to have a portfolio to provide a reasonable rate of return while taking less risk than it was in a lower yield environment. As part of that, we've been talking with clients about what cash levels are able to provide with money markets, as Derek pointed out, that can now pay in the 5% range. And as he pointed out, the short-term rates, when interest rates go down, will also pull back. So now I think is a really good time to consider transitioning some of those short-term savings into longer duration opportunities that could tie these rates in for a longer period of time. We're excited to see some opportunities to buy at reasonable valuations. And from a point in the market cycle that we are, as interest rates are likely cresting, investing during periods of time like this has historically paid off pretty darn well. The concentration of those magnificent 7 NASDAQ holdings in the S&P are kind of isolated in that a lot of the market is very fairly, if not undervalued. From a financial planning perspective, we think now's a really great time to make sure that your financial plan reflects your current reality. And if you haven't done that for a while, please reach out to one of us, whether it's Jim, Ed, Todd, or myself, in order to make sure that your financial plans are accurate. And let's see if there's any opportunities for adjustments that we can make. At Evergreen, we really appreciate the opportunity to serve you and use this mechanism as a vehicle to help keep you informed and connected. As you know, the market is constantly planning. It is constantly evolving. So it's crucial to stay informed of the latest trends and developments. Along the way, we have a couple ways to make sure that you stay informed in addition to this quarterly webinar. Please do make sure that you are subscribed to our monthly market update. And if you're not receiving that, please send an email to info@egwealth.com. You can also follow us. We're on LinkedIn and Facebook, so please look for Evergreen Wealth Solutions there. And please contact our team with any questions that you may have. We appreciate the opportunity to serve you and look forward to connecting with you again soon. Have a great day.